Bank of Canada dropped a bombshell when they raised the benchmark interest prices by 1% instead of the 0.75 we were all expecting. What does this mean? Welcome to the channel. My name is Jeff McLennan. I am a realtor on the Valley McLennan real estate team in Westminster. If you want to get kept up to date on everything going on in real estate in the Lower Mainland with a focus on New West, hit that subscribe button. Today we have Stephanie Barritt, who is a mortgage broker that I have been working with for years. And when the Bank of Canada dropped this announcement that was bigger than what most of us were predicting or expecting, the first person I called was Stephanie, and I thought it would be a good idea to get her opinions on what this means for you and how this might change real estate over the next few months.
We were expecting another rate increase, which I don't think surprised anybody. The surprise was the amount. Generally speaking, over the course of many, many years, when the Bank of Canada changes rates, it's usually by a quarter point. We've seen 50 basis points increases and decreases at times, like in 2008, when we saw obviously the economic issues that came up surrounding the subprime mortgage crisis in the US. So seeing 1% was definitely surprising. We'll put it that way.
Now, you used the word necessary. Can you elaborate on that?
We're in a environment right now where unemployment is incredibly low. People have had a lot of money over the last couple of years, and as a result, inflation is rampant and somewhat out of control. There's one tool in the toolbox to try and break the back of inflation, and that is increasing the central bank's increasing interest rates. Unless we all want to be spending $25 on a carton of milk in 6 months, the central banks have to somehow get a lid on it.
Like, why don't we start with buyers? Dollars and cents, what does it mean? Rates go up a full point. How much extra are people paying?
Well, on average, and you know what, I should have done those calculations prior to our meeting, and I've been on holidays for 3 weeks. I think it's about $25 per 100,000 for every quarter point. So a full percentage point would probably be about $100 for every 100,000 of mortgage dollars in extra interest. So, you know, there's definitely going to be a significant impact. If you have a $500,000 mortgage, you're going to see probably about a $500 a month difference, but it also depends on your amortization period, depends on a few different things.
Well, and that kind of brings me to a really flashy, scary headline, and I'm sure you've seen it. I've seen it all over the place. 1 in 4 Canadians is not going to qualify to renew their mortgage. What do you think of that?
Well, I think unfortunately it's potentially a bit misinformed. Renewing your mortgage does not require requalification. So this is one of the areas where banks actually would love for borrowers to have to requalify. It's actually the mortgage brokers across the country that a number of years back fought to actually keep it at the status quo, where if you already have a mortgage, as long as you've been paying your mortgage as agreed, when it comes to renewal, technically the bank sends you out that mortgage renewal agreement. You can check the box of 5-year term, 3-year term, variable, sign it and send it back and just continue to roll that mortgage. Oh, there's not even a credit check required to do that. So I think that that's a bit of a scare tactic, those headlines, and I think it's uninformed. The only time that you need to requalify, in which point they will run your credit again, they will look at your income and your job status, is if you're refinancing, so you're making any changes to the mortgage as opposed to a straight renewal, or if you have not paid your mortgage as agreed and the bank chooses not to renew you, which they do still hold that rate.
If I'm somebody who's starting a brand new mortgage right now and I'm asking myself, do I go variable or do I go fixed? What is your advice to them?
I wish I had a crystal ball to give you a black and white answer to that question. I really don't. It's very specific to the client and it depends on a number of things. So if you are a first-time buyer putting 5% down and you are borrowing at the top of what you already qualify for, I would probably say take the 5-year fixed. It's going to cost you a little more right now in terms of, you know, the black and white numbers on the page, but you're paying for insurance. And we buy insurance for a lot of things in our life, right? Things that we hopefully will never need it for, but you pay it happily on the off chance that it's going to be necessary. Someone who is, putting 30% down, they qualify for more than they're spending. They're maybe in a job where they know they're going to see some increase to their wage over the 5 years. They also have the ability to still sleep at night knowing that they're on a variable mortgage. A lot of people don't. So that's something to keep in mind. Your peace of mind has a value too. I still lean toward variable mortgages. I usually have my mortgages all variable just because you're able to be a little bit more nimble. Maximum penalties are 3 months interest. You do still have the option to convert to a fixed term if you choose to. And it just allows you to make a little bit more quick decisions without that fear of a large penalty looming. And of course, in the short term right now, for sure, rates are definitely lower still on the variable option.
You were talking to me about the differences between, like, I'm switching from Scotiabank to HSBC, and the different ways that variable, like how not all variables are the same as far as payments go. And I thought that was really interesting. So I was hoping you could kind of share that with the people listening.
Yeah, absolutely. So I think there is a tendency when we're chatting with clients to simplify things and say fixed or variable, like there's really only the two options, without digging a little bit deeper into that second option. And I don't even think every client knows that there are two options there. So the bottom line is the difference is adjustable rate mortgages, which isn't the term that we tend to use. We blanket them both with variable. But an adjustable rate mortgage means that your payment adjusts along with the rate. So when you start your mortgage, if your rate is 3%, and then we see a 50 basis point increase to prime rate, and your rate is now 3.5%, your payment will be changed to reflect that increase in the interest, so that within your payment, you're still paying the same amount towards principal onto the balance of the mortgage every month. A variable rate mortgage is different in that your payment is set on the day that mortgage is registered. So if you're set at 3% and your payment is set, even if that prime rate increase of 50 basis points happens, you're not going to see a change to your payment. What will happen is the amount of principal within your payment decreases because the amount of interest increases until you reach something called a trigger point. And if you get to the trigger point where you're not paying all of the interest or you're not paying any principal, then the lender will offset it and will change it.
So now I know you said you don't have a crystal ball, but I'm still going to ask you, what comes next?
Well, unfortunately, it's an answer most people aren't going to like. We're probably going to still see some more increases. I was just listening to an economist, Dr. Sherry Cooper, actually, and she said definitely probably another 50, and then another 50, and then maybe another 75. But she predicts before year end another 50. We don't know what that magic number is going to be to start to turn inflation around. The problem with it is it does take time. So even when these rate increases happen, it takes time to trickle through and see the results in our economy. So, they always run the risk and the danger of increasing too fast and causing recession, or not increasing fast enough and causing inflation, which is the boat we're floating in now.
I really appreciate you coming on. Whenever you do, you're always full of an absolute ton of insights. So thank you very much. If you want to get a hold of Steph, you can reach her at AskSteph.ca. I think next week, what we're going to do, I'm pretty excited. We're going to have, I just teamed up with Kelly Valley to create a super team. Going to bring her on the channel and chat with her about what she thinks going on in the real estate market. I think it's going to be very, very insightful. She is an absolute rock star in the industry. If you want to make sure that you catch that, please hit the subscribe button. And if you enjoyed this content, please hit the like button. It helps us be found by more people. Thank you guys very much.